Hello everyone, Kolonji Murray with TaxAssurances. Just want to do a helpful video today about investments and tax preparation. So quite frequently I'll come across a tax client that needs obviously their taxes done. But in having their taxes prepared, one of the items that they will give to me is their brokerage account from their investments. So whether it's Fidelity or Coinbase or some of the other brokerage firms that are out there, they'll bring in a statement saying, hey, my brokerage firm gave me this, I'm not sure what to do with it. I did do some trading activity, whether it's buying mutual funds or buying individual stocks or options or any other marketable securities that are out there. They're not quite sure how to handle that and what the implications are. So I kind of have to take that information and use that to prepare the return, along with obviously everything else. So say for instance, they obviously probably going to have a regular 9-to-5 job. So we're going to have that W-2. If they've got a business on the side, we're going to include that. But then again, there's that piece where you're looking at the investment portion of their tax return that needs to be prepared. So what I'll do is I'll take that statement and I'm looking for a couple of things. So first and foremost, I'm looking to see if they received any qualified or ordinary dividends, because we're going to track that on the tax return and include that again with that other income, and if they've got dependents or anything like that. So that'll be part of it. The other thing we're going to look for is any interest income that may have come out of the brokerage account activity for the year. So we'll look at that and be able to record that along again with all of the other activity that happened on the account, on the tax return and the taxpayer's life for that particular year. And then finally, like I was alluding to, is there's going to be information about the buying and the selling that occurred throughout the course of the year on that brokerage or in that brokerage account. And the way that works is they're going to summarize on the brokerage statement how much was long-term in terms of investments purchased and investments that are sold, and then how much is short-term. Short-term is usually within 1 year. So within 1 year from buying to selling is the short-term, and anything more than a year from the time that it was bought to the time that it was sold, that's going to be the longer term. But both of those we're going to want to track on the tax return. And make sure that we're including that information, because it's also going to be reflective of what the brokerage firm has already sent off, because one of the parts of this process is the brokerage firm is going to send that off to the IRS and to the state to let them know what has occurred in that account for the year. So we're just kind of matching that up. But again, when we're tracking the investments and what has been the difference between what was bought and what price was paid for and what was sold, we're tracking that. So in one sense, if we've got one scenario, I should say, if you've got a situation where, let's say for the full year, you paid $10,000 for an investment, and then let's say at the end of the year, you sold it for $15,000. Well, that $5,000 net difference, that's going to show up eventually, as I was saying before, on the rest of the tax return, meaning it'll be included with your W-2 and the interest and the dividends. Then if you've got a business and any dependents, it's going to show up as part of that on what's called the Schedule D. And again, that's that $5,000 difference. Now let's take it the other way. Let's say, for instance, you bought for $15,000 during the course of the year, and then eventually you sold it for $10,000. So you've got a $5,000 loss. But here's the catch. The IRS only allows you to deduct losses up to $3,000 at this point. Now, they may change it later on as of the recording of this video. That's the way it stands. But again, the cap that you can deduct of that amount that you lost is $3,000. However, you are able to carry the $2,000 forward until the next year, until you fully extinguish that $3,000 loss. But again, year in and year out, when it comes to investment losses, you're only allowed to deduct the $3,000. So those are the ways that you're going to track an investment account, an investment activity that occurred during a tax year, and how it's going to be reflected on your individual tax return. Obviously, if you've got more questions, by all means reach out. I would love to help. But until then, take care.